You're lying in bed right now. Maybe it's 11 p.m., maybe it's 2 a.m., and you just punched some numbers into a retirement calculator. You typed in your age. You typed in your salary. You typed in what you've got saved so far. And the number that came back made your stomach drop. Because according to that calculator, at the rate you're going, you'll be 74 years old before you can actually stop working. 74. And that's assuming nothing goes wrong. No medical emergency, no recession, no layoff. Just a smooth, straight line for the next 4 decades. Which, if you've been alive for more than 15 minutes, you know is not how life works. Here's what makes this worse. The median American household has less than $5,300 in a savings account. The average 30-year-old has roughly $20,540 saved for retirement. And 56% of Americans can't cover a $1,000 emergency without going into debt. That's not a statistic from 1985. That's right now. So you're lying there thinking, maybe I need to find a side hustle. Maybe I need to learn day trading. Maybe I need to find that one investment that'll 10 times my money. And I get it. I really do. Because when the gap between where you are and where you need to be feels impossible, your brain starts looking for shortcuts. But here's the thing that might shock you. The most reliable path to $1 million doesn't require a 6-figure income. It doesn't require picking the right stocks. It doesn't require timing the market or finding the next cryptocurrency. It requires $500 a month, and the one thing almost nobody is willing to give it: time. And what nobody tells you is that this strategy is so boring, so painfully unsexy, that most people will hear about it, understand the math, agree that it works, and still not do it. My name is Donald, and I spend way too much time reading about why some people quietly build fortunes, while most people stay stuck on the same financial treadmill for decades. If you're someone who wants to understand the actual mechanics behind building real wealth instead of just hoping your situation magically improves, hit that subscribe button. And if this video ends up changing how you think about money, a thumbs up genuinely helps more than you'd think. All right, let's get into it. Most people think building wealth is about making more money. Get the raise, get the promotion, start the business. And look, income matters. I'm not going to sit here and pretend it doesn't. But here's what's actually happening with most high-income earners in this country. There's a book called The Millionaire Next Door by Thomas Stanley and William Danko. They spent 20 years studying millionaires, and what they found broke every stereotype. The typical millionaire in America isn't driving a Ferrari. They're driving a 3-year-old Ford. They're not wearing a $5,000 watch. Half of them never spent more than $235 on a wristwatch in their entire life. They didn't inherit their money. Over 80% are first-generation wealthy. They built it themselves. And here's the part that flips everything on its head. Stanley and Danko found that for every actual millionaire wearing a $1,000 suit, there were at least 6 people earning between $50,000 and $200,000 who wore that same suit, but had almost no net worth. They looked rich. They weren't wealthy. Big hat, no cattle, as the Texans say. Think about it this way. Building wealth is like filling a bathtub. Your income is the faucet. But most people are so focused on turning the faucet up higher that they don't notice the drain is wide open. Lifestyle inflation, car payments, subscriptions, eating out 4 times a week, upgrading the phone every year. The water pours in and pours right back out. The boring millionaires, they didn't have the biggest faucet. They plugged the drain. They lived on less than 7% of their total wealth per year. They saved and invested at least 15% of their income. Not because they had to, because they understood something that most people don't figure out until it's too late. John Bogle, the founder of Vanguard and one of the most important figures in the history of investing, put it this way: the winning strategy is to own all of the nation's publicly held businesses at very low cost, and then hold them forever. That's it. No stock picking, no market timing, no guru subscription. Just buy the whole market and sit on your hands. And what I've discovered after reading every major wealth building book I could find is that they all converge on the same unsexy truth. The boring way is the only way that actually works for regular people. Let me show you exactly what I mean with some numbers, because this is where the math becomes absolutely unfair in your favor. Let's say you're 25 years old. You start investing $500 per month into a low-cost total stock market index fund, something like Vanguard's VTSAX, which has an expense ratio of 0.04%. That's 4 cents for every $100 invested, practically free. The S&P 500 has returned an average of roughly 10.2% annually since 1926. Adjusted for inflation, that's about 6.5% to 7% in real purchasing power. But let's use the nominal 10% for now, so you can see the raw compounding effect. At $500 per month, invested consistently at a 10% average annual return. After 5 years, $38,929. After 10 years, $102,422. After 15 years, $207,926. After 20 years, $382,846. After 25 years, $668,963. After 30 years, $1,130,244. You put in $180,000 of your own money over 30 years. The market gave you back over $950,000 on top of that. You didn't pick a single stock. You didn't watch CNBC. You didn't panic sell. You just showed up every month like clockwork with your $500. But here's where it gets really interesting. Look at the difference between year 25 and year 30. In those last 5 years alone, your portfolio grew by $461,281. That's more than it grew in the entire first 20 years combined. That's compounding doing its thing. As Bogle wrote, the magic of compounding is little short of a miracle. Each $1 invested at 9.5% grows to $2.48 in a decade, $6.14 in 2 decades, $15.22 in 3 decades, and $93.48 in 5 decades. Here's the part that nobody talks about. Let's say you waited just 5 years. You started at 30 instead of 25, still putting in $500 a month. By age 55, you'd have $382,846 instead of $668,963. That 5-year delay cost you $286,117. You didn't lose that money. You just never earned it. Because those early dollars had less time to compound. Morgan Housel, who wrote The Psychology of Money, made this point brilliantly. He said there are over 2,000 books about how Warren Buffett built his fortune, but none of them are called, "This guy has been investing consistently for 3/4 of a century." Buffett started investing at age 11. He's been at it for over 80 years, of his $84.5 billion net worth. At the time Housel wrote about him, $84.2 billion came after his 50th birthday, and $81.5 billion came after his 65th birthday. The man isn't the world's greatest stock picker. He's the world's most patient investor. Now, I know what you're thinking. Donald, $500 a month? I can barely make rent. And I hear you. So let's break it down. $500 a month is $125 a week. That's $16.67 per day. Here's what $16.67 looks like in real life. That's one DoorDash order you don't place. That's skipping the $6 latte and the $11 lunch combo. That's keeping your current phone for 1 more year instead of upgrading. That's the difference between a $1,800 apartment and a $1,300 apartment with a roommate. I'm not saying any of this is easy. I'm saying it's $16.67 a day. And over 30 years, that $16.67 turns into $1,130,244. This brings us to something that most people never consider. It's not just about the amount. It's about the order. There's a sequence that actually works. Step 1. Build a $1,000 emergency buffer. Just $1,000. Not 6 months of expenses. Just enough so a flat tire doesn't put you on a credit card at 24.99% APR. Step 2. If your employer offers a 401k match, contribute enough to get the full match. This is literally free money. If they match 50% up to 6% of your salary and you're making $50,000, that's $1,500 per year your employer hands you for doing nothing extra. Don't leave that on the table. Step 3. Pay off any high-interest debt above 7%. Credit cards, personal loans, BNPL balances. Every dollar of 22% credit card interest you're paying is a dollar that could be earning 10% in the market. That's a 32% swing. Step 4. Now, max out your Roth IRA. In 2025, the limit is $7,000 per year, which is $583 per month. Your money grows tax-free, and you pull it out tax-free in retirement. This is the single most powerful account available to regular people. Step 5. Go back to the 401k and increase your contributions beyond the match. The 2025 limit is $23,500 per year. Step 6. If you've maxed both of those, open a taxable brokerage account and keep buying the same index fund. The math is simple but powerful. And Burton Malkiel, the Princeton economist who wrote A Random Walk Down Wall Street, proved why this works. He analyzed decades of data and found that the vast majority of professional fund managers, people with Harvard MBAs and Bloomberg terminals, fail to beat a simple index fund over the long term. In fact, roughly 85 to 90% of actively managed funds underperform their benchmark index after fees. You're not competing with Wall Street by using index funds. You're beating them. Let me paint you a picture. I'm two guys. Same age, same income, wildly different outcomes. Derek is 25, just landed a solid job making $52,000 a year. After taxes, he takes home around $3,400 a month. He's excited. He's been grinding through college, eating ramen, driving his mom's old Civic. Now he's got real money coming in. So he does what everyone around him does. He finances a $35,000 car. Payment, $620 per month for 72 months. He gets a nice apartment downtown, $1,650 a month. He eats out 4 or 5 times a week, maybe $400 a month. New clothes, a gym membership with the sauna, a couple of subscriptions. By the time the dust settles, Derek is spending $3,350 of his $3,400 take home. He's saving $50 a month. Some months, nothing. Derek tells himself he'll start investing seriously when he gets a raise, when things calm down, when he's 30. There's always a when. 10 years later, Derek is 35. He did get raises. He's making $68,000 now, but he also upgraded the apartment, got a nicer car, started going on 2 vacations a year instead of 1. His lifestyle inflated right alongside his income. He's got $4,200 in a savings account and $8,300 in an old 401k he set up once and forgot about. Total net worth at 35, roughly $12,500. Now meet Marcus. Same age, same job, same $52,000 salary. Marcus read one book about money when he was 23. Just one. And something clicked. He didn't become a monk. He didn't eat beans and rice every night. But he made a few different choices. Marcus kept his mom's old Civic. He got an apartment with a roommate for $900 a month instead of $1,650. He cooked most of his meals. Not all of them, but most. And on day 1 of his new job, he set up an automatic transfer. $500 per month into a Roth IRA, invested in a total stock market index fund. He didn't think about it. He didn't check the balance every week. It just happened, like a water bill. Boring, automatic, invisible. Here's what's fascinating. Marcus didn't feel deprived. He still went out on weekends. He still bought a new jacket when he needed one. The difference between his life and Derek's wasn't dramatic month to month. It was maybe $650 a month in spending. That's it. That's the entire gap. But 10 years later, Marcus is 35. His Roth IRA has grown to approximately $102,000. He also contributed enough to his 401k to get his employer match, adding another $41,000. Total net worth at 35, roughly $143,000. Same starting point, same income, same city. One person is worth $12,500. The other is worth $143,000. A $130,500 gap. And that gap doesn't close. It widens. Every single year, it gets wider, because Marcus has $143,000 compounding, while Derek has almost nothing. Fast forward to age 55. Derek finally started investing at 36 after a wake-up call. He's put in $500 a month for 19 years. He's got around $342,000. Not bad. But Marcus, who started at 25 and never stopped, at age 55, he's sitting on approximately $1,020,000 from his Roth IRA alone. Add in the 401k match money and its growth, and Marcus is well past $1.4 million. Derek is lying awake some nights, doing math in his head, wondering if he can retire at 67. Marcus already knows he can stop working at 58 if he wants to. Not because he earned more, because he started earlier and never stopped. Same starting point, same income, one choice, over $1 million in difference. So why does this happen? If the math is this clear, if every book and every study and every calculator says the same thing, why do most people end up like Derek and not like Marcus? Here's what's happening in your brain. The first trap is something psychologists call temporal discounting, which is just a fancy way of saying your brain values $100 today way more than $1,000 10 years from now. Your brain evolved to prioritize immediate rewards. A meal right now beats a theoretical meal next winter. That served us well on the savannah 200,000 years ago. It destroys us in a world with Amazon Prime and one-click checkout. Every time you look at that $500 and think, but I could use this for a new coat, a weekend trip, the latest iPhone. That's temporal discounting at work. Your brain is literally downgrading the future to make the present feel more urgent. Morgan Housel described this perfectly. The most powerful and important book about investing should be called Shut Up and Wait. It's just one page with a long-term chart of economic growth. But nobody can sell that. Nobody can make a TikTok about it. So instead, we chase complexity. The second trap is hedonic adaptation, which means you get used to everything. That new car? Amazing for about 3 weeks. Then it's just your car. That bigger apartment? Thrilling for a month. Then it's just where you live. The Millionaire Next Door research showed this in vivid detail. The trust officer in the study wore a $5,000 watch and drove a current model luxury car. He looked richer than every single decamillionaire in the room. But those decamillionaires, the people actually worth $10 million plus, were drinking Budweiser and wearing off-the-rack suits from JCPenney. They understood something the trust officer didn't. The thrill of the purchase fades. The wealth you build instead of spending doesn't. The third trap is social comparison. You're not just making financial decisions in a vacuum. You're making them while watching everyone around you upgrade their lives. Your coworker gets a new BMW. Your college roommate just posted pictures from Santorini. Your cousin just bought a house. And your brain screams, you're falling behind. But here's the beautiful paradox. You're comparing your financial reality to other people's financial performances. You see the BMW. You don't see the $740 monthly payment. You see the Santorini trip. You don't see the $6,800 on the credit card. You see the house. You don't see that they're stretching every paycheck to cover the mortgage. Stanley and Danko called this being a UAW, an underaccumulator of wealth. These are people who earn good money, but spend it all performing wealth instead of building it. For every millionaire who owns a $1,000 suit, there are 6 non-millionaires wearing the same suit. Big hat. No cattle. And here's the thing that connects all of this. Once you cross certain financial thresholds, your psychology actually shifts. When you have $0 saved, every financial decision feels like survival. Should I pay the electric bill or buy groceries? That's scarcity mode. Your brain can't even think about investing when it's stuck in fight or flight. But when you hit $1,000, then $5,000, then $20,000 in savings, something changes. The anxiety starts to quiet. You stop making decisions from fear and start making them from clarity. And when you hit $100,000, which is the hardest milestone of all, compounding starts to become visible. You watch your portfolio jump $800 in a single day, and you realize, wait, my money is making money without me doing anything. That's the shift from survival mode to growth mode. That's when boring starts to feel powerful. So there you have it. Turning $500 a month into $1 million isn't about finding a secret investment or timing the market or following some guru's stock picks. It's about automating a boring, consistent contribution into a low-cost index fund and then doing the hardest thing in all of personal finance. Nothing. Just letting it sit there and compound while everyone else is out there chasing shortcuts that don't exist. Benjamin Graham, who literally wrote the book on intelligent investing and mentored Warren Buffett, closed The Intelligent Investor with this observation. He described 2 partners who spent their careers using a simple, disciplined approach to investing. They avoided anything that appeared overpriced. They diversified, they stayed patient, and they averaged about 20% per annum for years. Their secret wasn't genius. It was discipline and the willingness to be bored while everyone else was being clever. Let me leave you with one image. It's 30 years from now. You're in your mid-50s. You check your portfolio on a random Tuesday morning, and it says $1.1 million. You didn't win the lottery. You didn't inherit anything. You didn't start a tech company. You just did the boring thing every single month for a very long time. And now you're sitting there with something that 88% of Americans will never have. Options. The option to keep working because you want to, not because you have to. The option to help your kids without going into debt yourself. The option to wake up on a Monday morning and know that you're going to be okay. That's not a fantasy. That's math. The question isn't whether $500 a month can turn into $1 million. The math already answered that. The question is whether you're willing to be bored long enough to let it happen.